Good morning, fools. I'm Matt Trogdon, and this is Out on a Limb with Morgan Housel.
We just thought of the name just now.
Just now. Morgan, last week you wrote what to me was a depressing article because you said that no matter how good of an investor I am, luck is going to determine whether I'm successful.
I think that's true, but there's an important point to make, and that's luck over any specific period of time. So if you say, I want to be an investor for the next 10 years, specifically the next 10 years, you're relying on some luck in there. Even if you say, I want to be an investor for the next 20 or 30 years, specifically at the end of 20 years to this day, that's when I'm going to stop investing. There's a lot of luck that you're counting on in that. So in the article last week, I showed, if you took a bunch of investors and they all invested $500 every month for 20 years, just dollar cost average into like the S&P 500.
Which is good advice. That's
great advice. That's fantastic. If you do that every month for 20 years, that's like the best investing behavior you can imagine.
Right.
But so I looked back at 140 years of data and said, what was the best time to do that and what was the best? And even over a 20-year period, the results differed by 7-fold between the luckiest investor and the unluckiest investor. If you invested during a 20-year period from 1932. Or a 30-year period, I should say, from 1932 to 1962, you did fantastic. But if you invested from 1962 to 1982, you did terrible. Even if you invested the exact same way, luck was involved in that. So the takeaways I had from the article is, one, it really shows how important diversification is. Because if you're just relying on stocks in order to make it to your goals, there's some luck involved in that too. So that's where having bonds and real estate and you invest in stamps. I know you have a big stamp
collection.
I have a big
and baseball cards.
I made that up, but let's go with it. And also the importance of being flexible with your time horizon. So rather than saying I'm going to retire on my 61st birthday, well, that might work, but you're relying on the market. You're really relying on the market being in your favor on your 65th birthday. Where if you can say, hopefully on my 65th birthday, but maybe I can work for a couple more years, maybe I can wait it out. Having flexibility in your time horizon is really important.
So that's the key. I think a minor related point is...
You're still depressed, though.
I'm feeling better.
Okay.
But if luck has that big of an impact over 20 years, imagine how much of an impact luck has over 3 years.
Oh, no, that's absolutely true. When you look at that same 140 years of data, if you look at it in a one-day interval, the market has almost exactly 50-50 chance of finishing up or down. After 10 years, it's about 68% that you have 68% chance that you have of earning a positive return. No, I'm sorry, in a 1 year, I should say it's 68%. In 10 years, it's 85%. In 20 years, it's 100%. That over a 20-year period, there's historically every 20-year period has earned a positive return after inflation. So you really have to go out decades as an investor, and that's when people talk about investing over a 1-year period or a 3-year period. It's not really investing. That's gambling. That's much more closer to speculation. It's really not until you're investing for 10, 20 years that you can be very confident that even amid wars and recessions and all the bad stuff that has happened over the last century, that over a 20-year period, you can be reasonably confident that you're going to earn a positive return in the market.
So I really need to be long-term. I need to diversify, and I need to be flexible in what my time horizon looks like. And just stop, so I need a backup plan.
Just stop being so depressed. Really.
Stop being so depressed. What's on tap for this week? I know you hate that question.
I do, and I'll go with it anyways. I flew from San Francisco to Washington, D.C. this weekend, and a nice young lady sitting next to me was terrified of flying, so much that she was shaking so violently amid some turbulence that her knees kept smashing into mine. And when we got off the plane, she walked to the curb, got in a car, and drove off. And what's interesting is that there's some research that shows that your odds of dying in a plane crash versus your odds of dying in a car crash
way lower.
If you drive for 12 miles, you are at more risk of dying in a car crash than you are flying coast to coast. So it's just I'm just writing about how people perceive risk almost always incorrectly.
Well, we look forward to seeing it.
And next week.
Thanks for your time, Morgan. Thank you for joining us on Out on a Limb, and we'll see you next week.